I'll start the review and I'll answer questions at the end. Weekly chart, we're getting a fairly deep pullback after last week's downside breakout. After last week's downside breakout, and the sell-off was strong enough, I suspect there's sellers somewhere above. So my overall concern for the bulls, hopefully TradeStation doesn't crash on me. My overall concern for the bulls is that there's probably sellers somewhere above. I'm going to go back. I'm going to be cautious not to click too much on the chart for now. And same thing here. Big bear bar, two-legged pullback, probably sellers somewhere above and a second leg down. But obviously disappointing for the bears. The bears, they were disappointed by Monday's gap up and rally that many of those bears who sold the close here scaled in, got out break even back down here. Coming into the day, the market gapped up and we were getting really close to this area right here, 60.75. That was the breakout point from last Thursday. That was the breakout point of last Friday's bear breakout. The bears, they would see that area as a credible area of resistance. And therefore, if we got there, bulls would probably sell out of longs and bears would look to sell. Bar one, bear bar after the gap up, but strong enough gap will probably go get at least a second leg. And then we broke above one, found sellers. Not a great sell below one, just like not a great sell below two, not a great buy above one. Three, now we have three consecutive trending bars with a high above the high of the previous bar. However, no bars closing above the high of the prior bar, and lots of overlap increases the odds that we're going to have a lot of trading range price action. For outside down, bear bar, good for the bears, probably going to get at least a second leg down. But you can see what it's forming. It's forming an expanding triangle, and that lowers the need for the market to get an outside down bar. 5, bull bar, reversing up, inside bar, closing on its high, good for the bulls. Probably going to go at least a little bit higher. 6 consecutive bull bars, 5 and 6. Probably buy the close and buy the pullback, betting on a bounce and a second leg. Bears that sold the 5 high or the 4 high are trapped. And if you're a bear and you sold and you're disappointed by 6, it's reasonable to buy back your shorts. 7, 3 consecutive bull bars, good for the bulls, probably going higher. 8, a little bit of a buy climax bar, increases the odds we're going to go higher. But what do you notice here? Well, for one, if you remember what I talked about, I can't really move the chart. I was afraid this was going to happen. Let me give the one. Let me let this catch up. I'm not sure why TradeStation's doing this right now on this computer. We'll leave it like that. Anyways, good enough. 8, bull bar, but what do you notice? It's testing this area up here. Last Thursday's breakout point low, and that's a magnet. I believe it was 60.25. That's right around the upper third of bar 8. 9, bear bar closing on its low. Because this rally from the 5 low, because the rally from the 5, from the bottom of 4 up to the 9 high, it's possible that it's a leg in a trading range, and that increases the risk that we may go more sideways here. You can see we've been in a tight bull channel for most of the Globex session. We had a spike, pullback, channel, and when you have a channel looking like this and then a bull breakout on the open, what is that? Well, that's a possible bull breakout of a bull channel, and that increases the risk that the breakout fails and that the market reverses down. So that's my overall concern for the bulls. This might be a trap, which means this rally on the open is actually quite dangerous. But bulls get out below 9, and then they get out below 9 or above 10. Bears, they can sell, but probably better to use a wide stop, scale in, or wait for more selling pressure. At a minimum, they'll probably have to form a tight bear channel if they're going to get the downside breakout. 13, 14, 3 consecutive bear bars. Good for the bears, probably going at least a little bit lower. And then 15, bull bar, doji. Not a great buy for the bulls. Probably sellers above. You can see it's a bad second entry. And if the bears can continue to get the tight bear channel, that'll increase the odds we get a bear breakout. 16, bear bar, closing on its low. Good for the bears. Looks like we may end up going lower and testing back to the open. And the breakout points, the 4 high and the 5 high. We came really close to closing the gap from yesterday's high down here. And therefore, that's a reasonable magnet for the market to test as well. 17, doji, 16 and 17. Good for the bears. Looks like we may go a little bit lower, trying to form a parabolic wedge with 10, 15, and 17, but not a great, really not all that great. And that's because parabolic wedges are breakouts on higher time frames, and it's reasonable for the market to test back down to this area. 18, bull bar, price sellers above. 19, bear bar, good for the bears. And then finally, we started getting a series of bear bars on 20 and 21. 21, doji at the moving average, but how many traders are going to buy at the moving average when the market looks like this? Probably not all that many. And because of that, it's really not a great buy. It's really not a great stop entry buy above 21. 22, consecutive bear bars, 21, 22, probably going at least a little bit lower. And then we tried to get a reversal up 23, and we just couldn't do it. What do you notice about the moving average here? One, we're not rallying far above the moving average. One, let me back up. One of the problems that the bulls have is that we're touching the moving average and we're not racing to the upside. There's not a lot of buying pressure at the moving average. And if that's the case, traders may see this as still expensive, and which means the market may have to probe even lower. Outside down 24, bulls are now unable to keep the market above the moving average. And then we had another bear bar 25 and a give up bar. As a strong enough bar, we're probably going to get at least a second leg down. Let me just get a sip of water here. $26, follow through selling, good for the bears, but consecutive sell climaxes increases the odds that we're probably going to find buyers fairly soon. But if strong enough sell off, whatever reversal up we get is probably going to be minor. 27, another bear breakout. We had a big breakout bar 25, smaller bar 26, and a bigger bar 27. That increases the odds that we're probably going to find buyers and get a bounce. And then 28, bear bar closing on its low, good for the bears. But now we're starting to get closes. We're getting smaller tails. 28 has a smaller tail than the past 3 consecutive bear bars, and it's coming later in the sell-off. Plus, most of the bar overlaps 27. And that's a warning that it's climactic behavior. If you look on a smaller time frame, 26 and 27 would be a channel, and 28 would be breaking out below the channel. That increases the odds that we're probably going to find buyers fairly soon. 29, reversal up, closing above the midpoint. Good for the bears. Probably buyers in this general area. And I suspect we'll probably test back up to the 1 low or the 4 low. And maybe the 25 close. It's possible we get all the way up to the 24 low, but the bulls need more buying pressure. They need to stabilize the market if we're going to do that. Rally 30, probably strong enough for a second leg up. And then we formed consecutive bull bars. Not a good buy, not a good sell below 31, probably buyers below. It's a bad low 1 short. Outside up 32, but now it's 2 legs up, rally, pause, second leg. And there might be sellers above this high. 33, you can call it a low 2 if you want. Low 1, 31, low 2, 33. But 3 consecutive bull bars, not a great sell below 33. And then 34, not a good entry bar after 33. Lots of overlap in a tight trading range over the past 3 or 4 bars. probably more sideways. Bull bar 35, good for the bulls. Bulls want a bull break out of the channel. They want a bull break out of the bear flag. Bear flag 29 low, 32 high. They want a bull break out and measure move and a test of the 24 low. And they tried. If you remember what I said I thought the bulls on 36 as it rallied, they really needed to see a strong bull bar with follow through. Otherwise, too much risk, we reversed down. And that's what we did intra bar. The market rallied on 36 and then sold off on 36, but now it's a low too. Follow through selling 37, good for the bears. Consecutive bear bars 36, 37. Probably going to get a second leg down and a test of the 29 low. But if we do get down to 29, I suspect there's going to be more buyers down here than sellers, and we'll probably start to go sideways in a trading range. If we can stabilize the market, maybe then we'll test back up to the open of the day. Not a great buy, 38, probably sellers above. And then 39, not a great buy either. Second leg down after the 36, 37 sell-off, but probably going to at least go a little bit lower. 40, bear bar, close below 39. Good for the bears, but a close at the midpoint of the bar, bad for the bears. Micro channel, 36 high, 40 low, probably going to go sideways to down. Now we have consecutive bear bars, 40, 41, 2 legs down, 40, and then pause, and then 41, pause, and reversal. But the bulls really need to get some kind of reversal up. Probably buyers below 29. Always can't help but yawn for whatever reason right at this time. Probably buyers in this general area, scaling in lower. And then 42, doji. So now we're starting to form a series of bear bars, and that's a little bit of a warning. We're still in the micro channel. And then we got the surprise 43, probably strong enough to go at least a little bit lower, but I suspect probably disappointing follow through, and therefore we might get a bounce here. And instead we got follow through, good for the bears, probably going to go at least a little bit lower, but tail 43, tail 44, consecutive sell climaxes, 2 legs down at support, the 76 low, 78 low from yesterday, probably not going that much lower. And then we got the surprise bear bar 45, good for the bears. What about selling the close? Well, if you sell the close down here, that's a lot of risk, and you're basically selling pure momentum, and you're selling what's probably going to be support. Look at the daily chart. We had a low one short, this bull bar here, and then we rallied and went higher. And look what today did. It tested back to the bottom of the range from 2 days ago. Right here. Reversal up, 46, good for the bulls. I made the comment that bears probably get out above 46, definitely above 47. Now we have consecutive bull bars, 46, 47. Probably going to get a second leg up. 48, low one short, not a great sell, and therefore buyers below. And then the bulls, I thought it was a reasonable, pretty much buy for any reason. You could buy above 46, buy above 47, stop below 47, taking a chance that we'd get up to these lows over here. I'll do it more bar by bar. And then 49, 50, 51, good for the bulls, still probably going higher, probably going to get up to the 43 high, 29 low at a minimum. We might get up to the 36 high later on in the day and possibly the open of the day. Good bar for the bulls, 53, 52, but a little bit bigger of a bar increases the odds that we get a pullback soon. But the first reversal down is probably going to be minor. 54 consecutive. Now we have a series of consecutive bull bars, probably buyers on the first reversal. And then 54, doji, probably sellers above, probably buyers below. 55, inside bar 56, followed through 57. We're getting followed through after the inside bar in the high 156. That increases the odds that we go a little bit higher. But I still think, I'd rather buy a pullback at this point. Too much risk. The problem is it's a tight bear channel, and the reversal up is probably going to be a minor reversal. And the bulls probably need some kind of higher low before they can get a second leg. And then 58, doji, not a great sell below, so probably buyers below. And the bears, they need to start making money below bars. Otherwise, we'll probably just go sideways, and we may drift up to the 36 high. And that's pretty much what we did. I made the comment that one of the problems that I thought that the bears were having is that they're not making money below bars. And if the bears can't make money below bars, that increases the probability that we're going to go more sideways to up. 65, 66 consecutive bull bars, probably buyers on a pullback in a second leg. Then we got the consecutive bear bars and the high one buy 63. But I made a comment, high one buy in a tight bull channel, not a great sell, probably more buyers in this area, and we may have to test the 66 high. That's obviously what we did over here. 60, 70, good for the bulls, but instead of finding more buying pressure, we found sellers, and then the market pulled back, breaking out below 69. A little bit of a surprise, so we may get a second leg down, but then we got the bull bar 75, and I thought that was a huge problem. I thought it was a problem for the bears. I didn't think we'd get a big second leg down here, but my one thought was even if we did, there's probably buyers below it. So it's really, it's pretty dangerous for the bears. Enough of a surprise, 74, that bulls used 75 to sell at a longs. But you can see if bull bought 75 and they bought more below 75, if they didn't panic, they still made money. And that was the rest of the day. Stop orders. I thought the first reasonable buy is buying above 5 or above 6, or you can buy above 7, even buy above 8. But 8's climactic late in a bull rally. And the odds are we're probably going to get a trading range open, especially if you understood the Globex chart, what I mentioned over here. We're in a tight bull channel on the Globex chart, and we got this late bull breakout at resistance on the daily chart. The Thursday breakout point low from last week, that increased the odds that there's probably going to be sellers in that general location. Bears that can sell below 9, taking a chance that they're selling the breakout point on the daily chart in a late buy climax. They can sell, stop above 9, taking a chance that we test down to the 4 low. Low probability, but really good risk reward. And obviously you can see a trader that sold below 9, if they were truly going to stay always in, they would never get out. They wouldn't get out here. They wouldn't get out on the reversal. They would need a credible buy signal bar to exit. And in this case, the credible buy signal was all the way down here. So a bear, let me choose my other computer because it's easier. If they sell below 9, their entry would be 57.75. They would exit above 46, which is this bar right here. And that would be 72.5. So that's roughly almost 80 points, maybe 75 points. And their risk on the trade was 8. It was basically a little less than 10 points. So they made more than 7 times their initial risk on the trade. But whenever you have a situation where you can make 7 times your initial risk on the trade, it's a fairly low probability trade. But from a context standpoint, a trader selling below 9 is actually a pretty sensible thing to do. Traders that wanted higher probability would start selling in here or 25 and 26. I think we talked. So stop orders, I said it's okay to buy here. Bears, they can sell below 9. Bulls get out. And, no reason to really buy anywhere in here. So bears probably stay long. I think it's okay for bears to get out above 30. But if they do, they probably sell again below 36 or below 37. And no reason for the bears to get out here if they're truly trying to stay always in. And then bears, they certainly get out above 46. Bulls can buy. I think it's buy for any reason. And all up here, what do? I think it's okay to get out of longs below 67. I don't think you have to, but it's probably okay. If you sell below 67, if we start to stall, which we did on 68 and then 69, I think you got to get out of shorts. Too much risk. Bulls will buy. And then bulls, if they buy 69, they probably get out after either below 72 or 73. And then really hard to trade this late in the day. But you get out of short. If you get out of longs, you can probably sell. But if you do, I'd get out above 75. And certainly below 70. If you're smart, I'd get out below 75 if I was short. Because too much risk that bulls will buy below 75, betting on a bounce. Limit orders. Having issues with buyers below 3 and then sellers above 10. That probably made sense. I thought sell above any of these bars probably made sense. And what about selling above 29? I think it's better to sell below a bear bar closing below its midpoint. So at a minimum, instead of selling 29, if I was going to sell above a bar, I'd rather sell above 28. It's a stronger bear bar closing above, below its midpoint. Which is right here. Otherwise, I thought we had a triangle breakout mode. We broke above the triangle and started reverse down. So when it started reverse down, I thought that was an okay sell. You could sell above 37, but you wouldn't get filled. You could sell the upper third of 37 during 38, and you would get filled in that instance. That's probably okay. I thought buyers below 48, but you made a comment that if 48 has a tail below the bar, it'll be a fairly low probability, low one short. And because of that, one of my concerns was 48, if it forms a tail, you might have more traders buying the close of 48 than buying the low of 48. If it's that obvious that if it's that obvious of a bad stop entry sell 48, you'll have a lot of traders just hit buy the market. And that can happen pretty regularly. And then buyers below 48, but never triggered. Buyers below 54. Really buyers anywhere in here. You can buy below 66, 65. You can buy the 64 low. You can buy the moving average for any reason. And you got the second leg. And then buyers below 75 for a bounce. Buy the close, sell the close. Probably buy the close 6, buy the close 7. And then I thought sell the close 25, 26, 27 is probably okay. Even sell the close 28. You could even sell down here 29 if you're willing to use the wide stop way up here and scale in. But at that point, it's probably better just to exit and wait and see what we get. And if the market starts to stabilize and the bulls prove they're not that strong, if traders conclude the bulls aren't that strong, they can look to sell again below 36 or 37. And then I thought sell the close, probably 43, 44, even 45, but that's just so dangerous. And for me, I just don't like selling this stuff. I get it. It's a windfall profit really quick, and that's great. But how many times do you see that? We have a lot of volatility on the daily chart right now. That's not normal. And for me, when these bars are moving fast, the easiest form of management, if you are going to take the sell, you just get out above the previous bar. So you sell 43, you put a stop maybe 10 points above 43. Maybe you put it 5 points above or 10 points above, and you sell the close. And then same thing here. If you're short, put a stop somewhere up here. Short, put a stop somewhere up here. And then if you get a bull bar closing above its midpoint, 46, you just get out above the bar. And then, I made the comment, buy the close all through here, probably okay. And then down here, I thought it was more opposite. You see a bear bar, 74, probably more traders buying it. And then 77, second leg down after 74. I thought that was a clear buy the close, but tough to do. It's a tough trade to take that late in the day, but it made a lot of sense. Okay, let me take a look at questions. Okay, where and when did you buy bar 78? Yeah, it was already long. I bought during bar 74. And when I saw 75 close the way it did, I thought we'd either go sideways and I could hold or buy more lower and then get a second leg up, or we just go higher. So in that case, it's kind of a lazy trade. I bought somewhere in here and basically just got out on the second leg. And that actually messed that trade up. I really should have bought more down here, but I don't think I did. I think I was too slow, and I just decided I bought somewhere in here, and I decided to hold it and get out on the bounce. But I should have bought more as it went down. I think, but anyways, that was what I did in this area. And that was just because I thought the context made sense. A question after going long on the 66 close here, where exactly did you scale in for break even? Well, I remember I bought, and I think I bought somewhere in here and then somewhere in there. But, that was overall. I don't remember exactly the location. Okay, question. What's your advice for a profitable trader out there? Option one, trade few contracts and take many trades per day. So trade small and take a lot of trades. Option two, increase position and take few trades per day. Keep in mind, Al says working on increasing position size rather than the number of trades, or a variety of the two. What do you recommend? Yeah, well, I think everything for me. I think a lot about processes, and when you're trading, in the beginning, you have to trade small and just get comfortable with following whatever that process is. And I think what traders should focus on is really identify what it is that they're trading, what trades they like, what trades they don't like, and really develop a process for taking those trades. I talk about a 3-bar micro channel all the time, or a breakout and follow through. And there's lots of 3-bar micro channels that you could take on a day like today. 3-bar bull micro channel, you can buy. 3-bar bear micro channel, sell the pullback. Here, 3-bar micro channel, sell the pullback. And 3-bar micro channel here, you can sell. Same thing here, but fairly climactic consecutive sell climaxes. 3-bar micro channel here, same thing here. 3-bar micro channel here. So the point is, there's lots of 3-bar micro channels on a day like today. And what I'd rather see someone do is really define what it is and what's the trading setup that they're taking. Once they've defined it, trade small, get comfortable trading it, and then eventually you can start trading a larger position size. But I'd rather see someone take 5 trades in a day, maybe 6, and work on slowly increasing the size rather than taking a lot of trades rather than taking a large number of trades. Problem with the large number of trades is it's really easy to screw it up. And if you're not careful, you'll end up getting tired or getting sloppy. And that's why I think it's really important to keep measurements of everything. I really think most traders, at the end of the day, you should be able to take all your trades and categorize them. I talk about Andrew Miniker quite a bit, but the trade types, he's the one I heard that from. Type 1, 2, 3, and 4. Type 1, you followed your process, you made money. Type 2, you followed your process, you lost money. Type 3, you did not follow your process and you did not make money. And then type 4, you did not follow your process and you made money. You really want to prevent type 3s and 4s, especially type 4. Type 4 is really, really dangerous. I think that's a much better approach. So for you, for me, if I was what I would do is I would have some sort of audit. I would track what I'm doing, and I would track what my setups are, what my trade types are, how many type 1s and 2s, first 3s and 4s. And then if I'm following my process well and the process is working, I would start increasing the size. But I wouldn't want to increase it too much where you're going to expose too much volatility. So I hope that makes sense. Does the 20-minute EMA crossing over the 60-minute EMA play a factor in your decisions? Well, sure it does. The 60-minute EMA is a reflection of the 60-minute chart. And if it's flat like this, I know we're around the 60-minute moving average, and therefore it'll probably add influence. Here, the 60-minute moving average has been flat for a couple of days. We gapped above it here, but we were below it down here. And that increased the risk that we were going to oscillate more around the moving average. A question. I missed most of the trades and ended up with a loss today, but most of my analysis was right. How do you learn to trust your instincts? Well, a trader's instincts, I always kind of think instincts is funny. Traders talk about, trust your instinct or trust your gut. And I don't really believe in that. I don't really believe in, trusting your gut or trusting your read. And the problem is, here's the problem with it. Traders know that they need to trust themselves, but they don't know what to trust. They don't know what's accurate data. Someone like Al, if you've been trading for a long period of time, you have data, you have experiences and impressions of what charts can do, and you just have a better sense of what's going on. And so the longer you trade, yes, you can trust your gut or trust your instinct. you know that when the market is free falling and you see 64, you see 43, 44, and 45, even though it's falling rather quickly, you know it's approaching support levels, and you know that it's a fairly low probability event, and it's also a fairly it's low probability, but it's also dangerous, and therefore it's more likely to be the start of a trading range than the new start of a bear trend. Same thing up here. You know that this right here is unlikely to be the start of a bull trend lasting all day, especially when you have this kind of a bull channel. In those things, I would see that more as experience. The problem that traders have, the biggest problem traders have is, it's kind of twofold. One, I talk about the caveman brain a lot. Our mind is really not conducive to be traders. Trading is kind of a screwed up profession. And if you think about it, you're basically living in a gray fog every day, and you're betting, you're going to hunt for a reward. You're going to hunt for food and resources. Obviously, that's money. And every day there's a problem. You're basically going out in the wilderness, and there's a probability that you're going to make money or lose money. And the problem is that making money or losing money is resources. And resources it's lifeblood. Without resources, you'll die. Let me get a sip of water real quick and I'll explain. And so the problem with trading is our brain, way back in the wilderness in caveman days, if you're in the jungle and you're hunting for food and you see a bush and you see something moving in the bush, you're going to be you're uncertain what's there. And because of that, you don't know if it's a harmless animal or if it's a cheetah or something a bear that could kill you. And because of that, our brains are naturally hardwired to sense uncertainty, and it's a survival mechanism. It's kind of like when you're outside in public, and if you sense something's just not right, or someone, maybe you just kind of feel on edge, your hair starts to stick up on your neck. It's the same thing with trading. The problem with that is, I believe it's the amygdala. Fight or flight responses travel faster than our critical thinking, and I think about that as it's a survival mechanism. A fight or flight response is kind of like an ambulance crossing an intersection. It always has the right of way, or it's a police car. But the problem with the amygdala is the problem with the critical thinking part of the brain is it will travel slower. And therefore, when your body senses that something is wrong, that you're going to be injured or you're going to get killed, it's always going to prioritize survival. And therefore, your fight or flight instincts will always kick in when trading. And so that what you have to do is you have to find a way to keep the cognitive brain up and running. That is your decision-making part of the brain. And so the problem is, in simple terms, the reason why you can't trust yourself is you're fearful that you're going to die. Your trading dreams are going to die if you're wrong. I think of trading, to me, the more I trade, the more I think casinos are fascinating. And I probably talked about a casino. I talked about it in Orlando. I probably talked about it every day. I've been in the trading room since Orlando. But what fascinates me about casinos, and I'm not a fan of casinos. I have a lot of problems with casinos. What fascinates me with casinos is it's really the math behind the casino. They have a 3 to 4% win rate on their bets, but they place, maybe, I don't know, 10,000 bets, 20,000 bets in a given day. Who knows how many bets they take? They take thousands and thousands of bets. And if you have a 53% win rate on average, and you take 3,000 trades a day, you're going to make an incredible amount of money. And if you vary the types of bets and the risk reward profiles on those bets, you're going to have a pretty, fairly smooth equity curve, I would imagine, at the end of it. And so what is the casino? What's the advantage the casino understands? Well, they understand that they're not going to survive if they only take 1 or 2 trades a day or 1 or 2 bets per day, but they're going to thrive and make a lot of money if they can take 3,000 bets a day. So the casino, they don't care about the number of bets. The problem with traders is that, traders really many traders they don't really have a clear business model. They know they want to make money. They know they want to trade, but they don't really know, what's the end goal? Okay. Let's say you want to make $300,000 a year. Okay. Well, how do you do that? What what do you have to make? How many trades are you going to take in a given month or a given year, and what would you have to do? So if you're going to make keep it easy, if you're going to make 100% return in a year trading intraday, you've got to make, let's say, and you're going to trade 10 months out of the year, you've got to make about 10% per month. And therefore, you've got to make, if you're going to trade every day, let's say you have to make about 0.5% a day, assuming you're going to trade 20 days out of the month. Then you have to find some sort of trading system. You got to build a trading process or a trading system. You got to start with what your setup going to be. It's going to be a 3-bar microchannel, or let's say it's a breakout and follow through. Then once you have that, you have to understand the overall probabilities of that trading plan. Once you have the overall probabilities and you have your financial goal in place, it will make trading a lot less stressful. So the problem you have, if I had to guess, answering the person that asked this question, how do I trust myself more? You really don't have a plan. You think you have a plan, but you really don't have a plan. For me, when I think of a trading process or a system, I think about a hedge fund. It's very clear. It's kind of like you should think about your trading as, Goldman Sachs is sitting you at this desk. They're going to pay you a lot of money to basically every time this trade shows up, this 3-bar microchannel, this breakout and follow through, whatever it is, they're going to pay you a lot of money to pull that lever and take the trade. And if you don't take the trades and you don't pull the lever when you're supposed to, you're going to get fired. It's not your job to design the best trading plan in the world. It's your job to operate it. The reason, but the problem is, we as traders don't give ourselves a clear understanding of what it is that we're trying to do. And so I know it's a lot of information, but the reason you're uncertain is you really don't know what you're doing. And that's just that's just the reality. You have to know what your plan is, and you have to know what your trading setup is. How do you define it? That's kind of the best answer I can give you. All right, let me take a look at more questions here. It's tough for me to hold swing trades. I always scalp and end up mostly break even. How do I adjust this mindset? Well, it's not adjusting a mindset. It's understanding, the problem with swing trading is most of the time the market's in a trading range. When you look at it, I call these days beginner's luck, and I stole that from Ali. Beginner's luck because the trader sells below 9, they put a stop above 9, and they hold, and they make 70 points on the day. And so what do they think? They think to themselves, oh, wow, this is great. I'm just going to swing trade every day and make a ton of money. And then they look over here. That trade station's going to do this to me. Let me try this. The point is, most days are trading range types of days. And because of that, what ends up happening is traders will they'll start swing trading when they see a large trend day, and then they'll start trying to swing trade on a trading range. And the problem is they're going to give up all their profit. I don't have a good example here, but if you think about a trading range, the problem with the trading range is, let me see if we're lucky. Let's get back to today. This happens a lot in trading ranges. Traders buy, and then they move their stop to break even, and they give up all their loss. And in a trading range, that happens a ton. And the problem with that is you start giving up too much of your profit. The issue, and I'm not being clear, I know part of the frustration is I can't go back on TradeStation. It's locked up. The challenge with swing trading is you have to understand the overall higher time frame context. Otherwise, you'll end up swing trading the bottom of a trading range or swing trading the top of a trading range where it's not likely to break out. So the point with that is I would start with really understanding breakouts and second legs, understand what's the criteria for a strong breakout and what happens if the market is in a second or third leg of a breakout. What's the criteria? What happens when you get a breakout in a small pullback trend or breakout in a trading range? Really understand it. I don't know how helpful that is, but the point is, it's not so much about changing your mindset. It's understanding when the environment is conducive for swing trading and when it's not. And usually that has to do with higher time frame context. Okay, question. With bar 5 through 8 being such a strong bull trend that failed, wouldn't you be expecting a measure move down from the opposite direction? Yeah, we got that. It's basically a trading range, the low of 4 all the way down to the lows over here. It's a trading range, and we broke below the range and we fell for a measured move. So that's certainly reasonable. All right, so looks like that's it for questions. Where do we go tomorrow? We have a lot of trading range price action over here. I think this bar is going to influence the next several weeks. And because of that, I still think the odds are real that we're going to get some kind of second leg. And this might be just a delayed second leg where we go sideways for 4 or 5 bars, 4 or 5 days in here, and then we try to get a second leg. So not a great buy above. So probably sellers above the high of today. And maybe if we're lucky, we'll find sellers and close on the low. But overall, I think we will fall below last Friday's low. But we'll see. All right. Thanks everybody for hanging out, and hope everyone has a great evening. And remember, review your trades. Think about what you did well. Think about what you didn't do well. And most importantly, review your trades from the standpoint of what your process is. Making money is not what you should look at. P&Ls are relevant. What is relevant is how well I followed my process. It doesn't matter if you made $1,000, $500, $100. What really matters is how well did I follow my process. Process over outcome. I'm a big fan, some of you know, I'm a big fan of Nick Saban. And one of the reasons why he was the Alabama football coach. One of the reasons why I'm a big fan of Nick Saban is he's obsessed over processes, and he always talks about that. And you can listen to some of his interviews. He talks about focusing on processes, and the outcome will take care of itself. And that's so true, especially with trading. You have to think about process. Being process oriented is going to keep you in the right direction. It'll help limit the emotions that you face. All right. Thanks everyone, and talk to everybody here in a couple of days.